So we've been managing this emerging market short duration corporate strategy now for 10 years. There's been such a change to really the opportunity set. And when I'm looking back, I can see that 10 years ago, we had, certain issuers that were the top 10 issuers. Now we have top 10 issuers. There's only two that are still in that bucket. 10 years ago, half of the top 10 issuers were in Latin America. Now there's only one from Latin America. We've really seen Asia and the Middle East grow quite a bit as in the opportunity set, while Latin America has become smaller, and of course we've also seen emerging Europe become smaller with the exit of Russia. So there's really been a change in the opportunity set. Positively, we've seen the consumer sector grow, which is where we always are looking for opportunity because we think it really is the core of what you're trying to capture in emerging markets, which is really the income level moving higher. So there's just been a change in what we have out there that we can buy and how we can express our views on the market. Other areas that have really changed quite a bit are the players in the market. So when you look at the investors that were still in the market 10 years ago looking at this space, you probably had a lot of crossover investors that really came in and left depending on their view of beta, what they're looking for, how they're trying to add risk to their portfolio. You probably still had quite a few investors, even in the emerging market space, that were just looking at some kind of spread to pick up to the sovereign. We've seen much less of that. We're really seeing, the investors looking specifically at these companies for their opportunities and the roles they play in a portfolio. On the investor side, we're also seeing really the end investor has really evolved, and we're seeing insurance companies, pension funds, big industrials, looking at this asset class as a place that can potentially offer them high quality carry. And so we get the question, why short duration? Why short duration EM corporates now? Does it make sense? We believe that a short duration EM corporate product still makes sense, despite the obvious trend now towards lower interest rates and inflation being behind us. Really, the strategy is about capturing the premium that is offered in the emerging market corporate space and targeting a lower volatility approach. And the shorter duration really is not lowering the opportunity set because a lot of emerging market companies really do issue in the 5-year and under space. So we have this great opportunity. The shorter duration is one tool to lower the volatility. And we do see that while we're in a certain trend for interest rates coming down, there could be volatility getting there. So for investors that are looking to capture really this premium and still, potentially getting, positive returns, we really see this as something that you can still have the exposure, have the diversification, and yet you're not really giving up something.